Hello everyone and welcome back to my channel, guys. In this video I'm going to explain to you how you're going to unassign yourself from your assigned cash secure put. Because the thing is, guys, I had so many videos, so many contents in my channel how to trade the cash secure put option on its own, just with the intention to buy stocks at the cheaper price. This is just one of them. I have plenty of cash secure put videos explain to you guys how we're going to start our covered strong strategy. We're going to start here, step number 1, selling cash secure puts. And of course, I got plenty of videos as well explain to you guys how you're going to start our wheel strategy with a cash secure put. Sell cash secure put, great. Get assigned, covered call. Or hold the shares. When you hold the shares, we're gonna sell covered call. Get covered call assigned, we're gonna sell the shares, everything. And then step 1. So step 1, step 2, step 3, step 4. Everything's done properly. Go back to step 1, and then we keep going with the wheel over and over and again. Same thing with the covered strong. Cash secure put, get assigned 100 shares, and then we're gonna do another short put option, another short call option, and we're gonna keep going this triangle here. Of course, not in terms of selling more cash secure puts, but in terms of the strategy. And today I'm gonna show you guys what you're gonna do if you sold your cash secure put options, but your goal is to acquire shares at cheaper price, but you want to keep managing the trades, collecting premium, and you're not ready to buy the shares yet. This is the video for you guys, because I'm going to show you all this thing here in terms of the maths, what you're going to do. Very, very simple, very simple, very straightforward, right? The only thing here they need to take in consideration, once you do this transaction here, you need to add here the fees, for closing this trade here and for opening another one. That's it, nothing else. The only thing is missing here is the commission, but apart from this, it's all GSM. So going back here to TastyWorks, for example, let's say we're going to sell here a 45 DTE. And you're going to use the IWM, which it is the ETF that tracks the performance of the Russell. And the thing is, guys, I love IWM. If you're selling put options, guys, on IWM, on a product that pretty much spend most of the time trading sideways, thank you very much. This is a cash flow machine. This is a cash flow machine. Anyway, you pick whatever product you might like. SPY, triple Qs, or stocks, or XLU, XLF, XLE, XLV, XL, whatever the ETF might be. Anyway, 45 DTE, we're going to open here the option chain. And, of course, remember the rules. If you don't know, guys, the rules for placing your cash secure put for the covered strangle or for the wheel strategy, the best thing you guys gonna do is this. You're gonna go back here and you're going to my channel and you're gonna see this list here. This is the playlist for those of you that want to learn how to trade options. And if you want to learn how to trade options, guys, click in this link here. And then you're gonna learn how to trade options for free. One of the best playlists you ever find on YouTube. It's free, by the way. And from here, for those of you that are option traders starting right now, guys, you can improve yourself. Everything you need is here. The only thing you're gonna do from here after it is what? You pick your strategy, maybe the vertical spreads, or maybe the covered strong, or the wheel strategy. This is pretty much what I do. Covered strong, and I'll transform into long-term investing, or I transform into a covered call, or I transform them into the wheel, or I transform them, just keep going the cash secure put. You pick your poison, but keep on the link below and you're gonna learn all these things here, and I'm gonna keep adding a lot of more content to this playlist. But nevertheless, let's go back to TastyWorks now, because I want to show you guys something more crucial. Let me see if I can get something here to show you guys. Well, let me go back here to home. I'm just looking at my Twitter right now, guys, because I want to show you something really cool to you guys. Where is it? No, let me see if I look on my Twitter so I can find something to you guys. I haven't found, but anyway, so basically what I was saying was, so let's say, for example, we're gonna sell here a 16. Remember rule number 1, the stock is trading at the all-time high, pretty much like everything is doing right now, October 2024. We want to start at least, guys, 10%, at least 10%. And by the way, I'm gonna leave this Excel here, okay? I'm gonna leave this Excel here on the link below so you guys can go and download for yourself, okay? So you're just gonna put here the stock price. I'll tell you guys in a second what you need to do. Just you're gonna click on the link below and download this Excel for you to apply to your tradings. If you get assigned, what you're gonna do, okay? So you're gonna sell here the 16 delta, and if we do get assigned on $198, what are you gonna do? What you want to do? What is your goals? Your goal is to hold the shares. Great, get assigned. Then you're gonna sell call, or you're gonna sell here another put to transform into a covered strangle, or you're gonna just sell here a call to convert into a covered call. All right. But if you wanna unassign yourself, what you're gonna do is it's very simple. Okay. Let's go back here. So let's say, for example, the stock is trading today. Let's say today's Friday, last trading day of the week at $50. You got assigned on your strike price of 55. Okay. Your strike, let me see if I can, can make a little chart here so you guys actually know this one. So you guys can see, okay? Let me see if my screen. Okay, great. So here we go. We got here our $55 strike price. The stock is trading now at $50. Okay, this is Friday. All right. And then what's gonna happen is your cost on a cash account, let's say for example, to hold $55 strike price, you need to have at least 5,500. Why? Because remember, option multiplier. We have to multiply this by 100 for each contract. I'm talking about here just one contract. Okay, you need to fork here at least 5,500. Okay, the negative sign here doesn't mean you're losing. That's how much you need to have in your account to get hold of the shares here. Okay, if you have a cash account, margin you have probably you need way less. Okay, and then on Friday the stock opens at 52. Okay, remember we have our chart here. Our strike price here, it's 55. Friday was trading at 50. And then on Monday, opens up at 52. Okay? It's still below our strike price here of 55. Okay? So we're still trading the money by how much? By $3. Which it is what? Our intrinsic value. Remember, there's zero extrinsic value here because this option is already expired and is out and it's finished. So the only thing that we'll have left here is the intrinsic value. So what we're gonna do is, because the stock opens on Monday from 50 to 52, we're gonna sell the shares at 52. Okay, the shares that we're holding at the strike price at 55. We pay 5,500. We're gonna close at $52. And of course, for that, we're gonna receive $5,200. Very, very simple maths. Very, very simple maths, okay? And then what is gonna happen is we are going to sell further in time, let's say with a DTE, okay, of let's say 60 days. We're gonna sell another put at $55 again, the same put that we got assigned here on our first trade. And for that, we're going to collect $3 at least. Why is $3 at least? Because the stock is trading, okay, at 52. We are selling a put up here, 52. We're selling a put here at 55 with $3 of intrinsic value. But remember, we have 60 days to remain. So this option here will have a little bit of EV, extrinsic value. So basically, in real example, this is supposed to be worth, guys, $3 plus something. Let's call that for now. Let's call $3.50. Okay, but to make things easy for you guys to understand, let's call $3. What is gonna happen is you're going to get paid $300. Why? Because the option multiplier. This is per contract. $3 times 100, we're gonna get $300. Okay. What's the income cash? Our income cash, guys, very simple, okay? We sold the shares for 5,200, which was 52 shares times 100. We collect $300 in premium for the next put option that's going to expire in 60 days with the strike price just same as before, where we got a sign of $55. So basically, we collect 5,500, but we also had to pay 5,500 when we got assigned from our first strike price. So basically, guys, a net here of 0. We collect here 5,200 from selling the shares plus 300 for selling the new option. We got 5.5k, and then we also had to buy here for 5.5k. So basically we just squared off this trade, but we still have here this extrinsic value from this option. Let me clear the whole thing here, okay? Because we still have here our extrinsic value, because this option here will have intrinsic value plus extrinsic value. This option here have $3 of intrinsic value, which is real, okay, because our strike price is 55 and the stock is trading at 52. So we have here at least $3 of intrinsic value. But because we got 60 days here, these 60 days cost something. Because if the option buyer is going to buy this from us, he or she ain't gonna pay $3. They're gonna pay, let's say, $3.50. Let's make this thing very simple. So we're gonna make here 50 cents. In other words, we're gonna make a little bit more than we're going to square off here to become this trade 0. So this is very simple, guys. Very, very simple. So in other words, if you're using like TastyWorks, for example, okay, what you're gonna do is you're gonna come up here and you're gonna put covered. I don't know what kind of trading platform you might have. You might use Toss, you might use E-Trade, you might use Robinhood, you might use Schwab. It doesn't matter. I'm using TastyWorks in the example. I also use IB, and with IB it's pretty much the same concept, selling your shares. And if you cannot do in a go, because here with TastyWorks you go covered put, and what happens is it already sells the share for you, as you can see. In our case was $52, remember, and already selling another premium for you, another put. In our case was the 55. So okay, so if you have here, let's say for example 218, the stock trading at 217 in this case, okay? So our let's put $3 difference, something like that. So as you guys can see, our maximum profit here is $530. But of course, because we cannot replicate here exactly like I had in Excel, you guys get the point. Because here the stock is trading at 217, but the strike price, it is in the money. So this option has IV and also have EV. Okay, this is what made in option premium. This is what's made up, IV and EV. Okay, and of course, here we got also implied volatility, time, and so on. Very crucial that you guys do understand. Okay, but if you a little bit lost, just download the Excel below. You can put here, for example, on this Excel, your stock price today, what the strike price you got assigned, how this is automatically calculated. You don't need to touch this. And then the next day, how much the stock open at, what price, and then we're gonna sell another put here at the same strike price. Okay, this is already calculated. It's all good. This is how much you're gonna get, already calculate. This is your strike price, like I just said. How much premium you're gonna get. This is already calculate. This is already calculate. All formulas here. Very, very easy to follow. Okay, just click on the first link below and download that. So basically on TastyWorks, it's already done for you guys. But if you cannot do that, let's say you got assigned on $220 strike price. You're gonna come here, you're gonna press buy. Okay, you're gonna press buy that share, and then you're gonna, let me just clean this thing here. So let me see, buy. Yeah, you're gonna click sell because you hold the shares. Okay, you're gonna click sell your shares. First thing you're gonna do is sell your shares. Once you share your shares, you go to the Excel. Okay, you go to the Excel and put how much you sold your shares for. Let's say $5,000, whatever it might be. Okay, and then the next trade, what you're gonna do is you're going to go here at the same price, pretty much. Let's say you paid at the strike price of 220. Let's say you paid $22,000. Then you come here and you're gonna sell a put at the same one. Okay, the same thing. Because remember, you got assigned the shares, so you pretty much were forced to buy at this price here, and then the next day you're gonna sell the whole thing. You're gonna lose here, and you're gonna make some money here, but the difference you're gonna make, it is on the another put that you're gonna sell at the same strike price. So basically, you let me put here. So you were forced to bought your shares, and then you sold your shares, and then you sold the short put. So these two here was an income cash flow. This was a negative cash flow. But these two here, guys, it is equal. Plus a little bit, like I said to you guys, of the EV here, which it is the extrinsic value. Because this option here has some DTE. Okay, 60, 45, whatever you like. But anyway, it's very, very simple, guys. Very, you can do automatically, or in TastyWorks, you just press short put covered and does everything for you, okay? But if you don't know how you do, just fill these things here, okay? This is a formulas. I'm gonna change the colors so you guys can have a look. So for example, doesn't have formula, so you can come here and put a color of blue, and then let's say doesn't have formula. This one here, I think have formula, doesn't have formula. Okay, great. So you guys can see, okay? So basically what you're gonna do is you're just gonna fill here those ones that doesn't have color, and the rest is all calculate for you automatically. Okay, this is how, guys, you get unassigned on cash secure puts, okay, that got assigned. Okay, all those trades that got assigned, what you're gonna do is you can unassign yourself. In other words, you just put a EU and an N here before. You're going from getting assignment to unassign yourself on your short put. It's just a quick explanation. I hope you guys understand. So if you have any question, leave your question below, and then I'll get back to you as soon as possible. Okay, I hope this video has had some value to you guys, and if you had, don't forget, subscribe to the channel, leave your comments below, and share that with your friends. Press the like button, all those good stuff. Okay, all the best, stay safe, and happy investing.